for all of you who've been following us, we've been talking about digital trade, we've been talking about financial services, services in general, transport, and so on. The United Kingdom and Spain have a extremely strong bilateral relationship, and we trade a huge volume bilaterally of goods and provide services to each country every year. But always behind the trade of goods, we have to take into account VAT and taxation in general. Tax is a very a difficult topic generally, and it's critical when it comes to bilateral trade. We understand that it's not always straightforward for small and medium companies, particularly a good number of the members of the chamber, and so we're delighted to welcome today David Pruden, Will Pereira, and Phil Crowley. And on behalf of the Spanish Chamber of Commerce, David, Will, and Phil, thank you very much for your time and for your interest. We know these are difficult and challenging times. Everyone's extremely busy trying to get up to speed with the TNC, with the Brexit agreement. And we're delighted you spending some time with Spanish companies, not only Spanish companies, but companies with an interest in Spain and so on. And we do hope that this will be just the first, but not the last one, of events that we will be having with different departments of the British government, and in particular with Hmrc. So thank you very much. And I encourage all the members that are connected now to raise any questions. This is a privilege, and we should all be asking questions and listening carefully to what they have to say. So without further ado, muchas gracias, and thank you very much. I'll pass over now on to David.
Thank you very much, Eduardo. And it's a pleasure to be on this session today and to be able to give you a presentation on import VAT and postponed VAT accounting. So the contents of what we're covering, I think you can see in front of you now. So if we go forward to the next slide, please. Thank you. So I'll concentrate mainly on imports, and also to say that I will be talking, and I think we'll all be talking mainly about VAT registered traders, but there will be occasions where we're talking about non-VAT registered traders, and we'll make that clear when we're doing so. So just before we move on to it, imports, the first slide just on exports and dispatches and some of the sort of basics from the beginning of January this year, which is that movements of goods from GB to the EU are exports, but movements of goods from Northern Ireland to the EU continue to be dispatches. So for goods moving from Northern Ireland to the EU, the previous intra-community rules will remain, and business-to-business supplies, so that's supplies between VAT registered businesses and VAT registered businesses, are zero rated as dispatches. I won't talk to the next point, which is a specifically excise point, but the last point is important. For exports from GB to the EU, goods will be zero rated, whether or not they are excise goods. So next slide, please. So the other side of the coin, imports and acquisitions, which I'll focus on from now on. So again, from 1st of January, movements of goods from the EU to GB are imports and no longer acquisitions, which means if you're VAT registered, it's import VAT, not acquisition VAT that is due. But again, acquisition VAT will continue to be due on goods moved from the EU to Northern Ireland. Postponed VAT accounting is available to UK VAT registered traders who import goods into GB from anywhere outside the UK, or import goods into Northern Ireland from outside the UK and outside the EU. So postponed VAT accounting allows importers to account for and recover VAT on the same VAT return. But other existing means of paying import VAT are available, and it will be these that non-VAT registered traders will use to pay their import VAT when they make their customs declaration. So they'll either pay it up front at the point of import, or more usually they will use a duty deferment account. Different rules apply for goods excluding excise in consignments valued at £135 or less, but that's what we'll be covering a little later on. So on to the next slide, please. So to use postponed VAT accounting, simple. You select it on the customs declaration. If you're using chief, but as most people will do, you select it by entering the trader's EORI. If you're using CDS, you select it by entering the VAT registration number. You have to enter that in the appropriate box, and the guidance tells you exactly how you need to make that precise entry on the customs declaration. An online monthly statement is generated by when you make your customs declaration, which the trader, the VAT registered importer, can access and download, and that contains the information the trader will need to complete their VAT return. There's no requirement to be authorised to use postponed VAT accounting, but you do need to subscribe to CDS to access for traders to access that online monthly postponed import VAT statements. And to use postponed VAT accounting, the imported goods must be for use in the trader's business. So the importing VAT registered trader's business. I'll say a little bit more about that later on. Now, the final point I think particularly is relevant to this audience: non-established taxable persons, they are entitled to use postponed VAT accounting. But the next point is a general point. In order to import goods into the UK, a non-established taxable person needs to hold a UK EORI, and they need to instruct an agent to make the customs declaration on their behalf. So that point is true whether or not you use postponed VAT accounting. If you're a non-established taxable person, you need to have a UK EORI, and you need to get an agent and instruct them to make the customs declaration on your behalf. So next slide, please. Thank you. So, postponed VAT accounting can be used when imported goods are removed into free circulation from a customs special procedure. So I'm covering now just the circumstances where PVA is available. So if you put goods typically into customs warehousing, you can use postponed VAT accounting when you remove them from the customs warehouse into free circulation. Again, you just select this on the customs declaration, which does that. If you're excise trader, again, you can use postponed VAT accounting when imported excise goods are released for home consumption onto the UK market. Now, that includes when goods are released from an excise warehouse having been in duty suspense since the point of import. Now, the use of postponed VAT accounting is normally optional. However, traders who import non-controlled goods into Great Britain from the EU between the 1st of January and the 31st of December 2021, they must use postponed VAT accounting and account for VAT on their VAT return if they either delay their customs declaration, so that's under the staged approach to import controls process, or even if you don't delay your customs declaration, if you use the simplified customs declaration process to make a declaration in your own records. So that's the EIDR process. So put another way, if you use the EIDR, entry in declarants records process, on goods that you import from the EU to GB in 2021, you must use postponed VAT accounting whether or not you delay your declaration. Now, and just to emphasize, postponed VAT accounting in other circumstances is available but optional, and it's a permanent arrangement. This point's come up, is sometimes confused. Postponed VAT accounting is permanently available. So once 2021's out the way, free to use postponed VAT accounting, then onwards if you wish to do so. So next slide, please. So this is using someone to import goods on your behalf. So probably the focus here is not so much the non-established taxable person, because as you said already, if you're a non-established taxable person, you'll have to have an agent anyway, and you'll have to tell them how you wish the customs declaration to be made, and whether or not you want to use postponed VAT accounting. So I think that will need to be clear anyway in your relationship if you're a non-established taxable person with your agent. But otherwise, if you get a person or business to import goods on your behalf, and that can be anyone, freight forwarder, customs agent, broker, fast parcel operator, then you need to tell them how you want to count the VAT on the imports so that they can then complete the customs declaration in the way that you wish to do so. And you may already have. If you're used to bringing in goods from the rest of the world into the UK, again, this may affect some of you, less others. You may already have had an agent from the 1st of January. But you do need to tell them that you want to use postponed VAT accounting. Otherwise, in all probability, they will continue to use one of the other payment methods that they used prior to the 1st of January. So you need to tell them what you want to do and keep a record of what is agreed, and then everything is clear. Next slide, please. So I said I'd say a little bit about non-business imports. So you'll be able to use postponed VAT accounting to account for import VAT on your VAT return if you import goods which are for both business and non-business purposes, or if you don't know whether or not they were used for business purposes at the time you import them. So essentially the message here is we want to make postponed VAT accounting available where at all possible. So in most cases, you'll know they're for business, but we're saying here, if you don't know whether they're business or not, or if there is a mixture of business and non-business, you can use postponed VAT accounting anyway. The final bullet, the only time you are saying you can't use postponed VAT accounting is if you know at the time that you import the goods that they will definitely not be used for the purposes of the business who's importing the goods. So you know they're solely for non-business purposes, can't use postponed VAT accounting, you'll have to use one of the other methods of payment, so immediate payment or use of a duty deferment account. So next slide, please. So when you're completing the VAT return, so this will be anybody completing a VAT return in the UK, there are changes to the way that that return is completed because of postponed VAT accounting. The main one is that first one, box 1. You now include the import VAT under postponed VAT accounting in box 1 of your VAT return. You claim back the import VAT as import tax in box 4, but you would have done that anyway if you were importing goods. Box 7, you include the value for imports. And again, if you've been importing goods into the UK from the rest of the world, there was no change there. Again, that may not apply to everybody on this call. And the normal rules about what VAT can be claimed as import tax apply. So the same as if there were acquisitions and you couldn't fully deduct the import VAT. So if you were partially exempt, typically, exactly the same rules determine how much of the import VAT you can claim as import tax. The monthly Pva statement mentioned, that's what you need, and that will show you the total import VAT for the month and how to and the guidance on how to use that to complete your VAT return. Now, I mentioned if you delay the supplementary declaration, the option to do that. Now, if you do delay the supplementary declaration, you won't have your Pva statement yet because you want to put in the customs declaration, and in those circumstances, you estimate the VAT to go on your VAT return from the other records that you have, your other business commercial records for what you used for your entry and declarant records. Then when you do complete your Pva statement, you will be able to adjust that estimate to precisely account for the VAT as per the Pva, as per the information on the Pva statement. Bear in mind, if you're fully taxable, this is always going to be an in-out transaction anyway. So the VAT that you're declaring in box 1, if you're fully taxable, will be the same as the import VAT that you're then claiming back in box 4. Next slide, please. And accessing the Pva statement. So I said on an earlier slide, you do need to access this to the CDS so Customs Declaration Service. You do need to access that to view and download your monthly PVA statement. And if you may already have access to CDS, that's unlikely, because most people will be making chief declarations, and in those circumstances, you will need to register to access for CDS and subscribe to CDS first. So, I mean, so just to emphasise, whether or not you make a chief declaration or a CDS declaration, the PVA statement is on CDS. So that's why if you're making a chief declaration, you need to register for CDS. It is solely for the purposes of accessing your PVA statement. It doesn't go any wider than that. Signing up for CDS should only take a few minutes. And the first 3 monthly PVA statements have now been published and are available. What I should say is we have had a few problems with both people trying to access CDS and with the information that is appearing on PVA statements for the first few months. For January and February, some of the information wasn't as it should have been. But we are working to resolve any access to CDS problems that people may have, and you can come to Hmrc on the normal sort of chief helpline or whatever the normal address is for queries if you do have any problems accessing your PVA statement, and we can let you know what that is. If you do, if you have problems, and we'll make sure that those are sorted for you. A final point. Each member of Vat Group that imports goods will have their own EORI and should sign off for CDS to access their statement. And the representative group member will then have to collate the statements to complete the VAT return. Now that's different from what would have happened with C79s. So if you import it, if for any of you that were used to importing goods from the rest of the world into UK before the 1st of January, then the representative group member would be the person who got the hard copy C79. It's different now. Each member of the VAT group has to access their own PVA statement and then forward it on to the representative group member to complete the VAT return. So that is a slightly more onerous process than what existed for C79s. I think that's me done. Obviously, happy to take questions later and hand you over to Will. Thank you.
Thank you, David. Okay, yeah. Thank you, David, and hello to everyone that's joined. My name is Will Pereira, and I work on the VAT policy for low-value overseas goods at Hmrc. Today, I'll be talking through the next 2 slides on overseas consignments valued at £135 or less. So the UK has introduced a new model for the VAT treatment of overseas goods, and that's to improve both the efficiency and compliance of businesses accounting for VAT. The new model applies to goods imported into Great Britain from overseas and goods imported into Northern Ireland from outside the EU. One of the main changes here is that VAT collection on consignments of goods valued at £135 or less has been moved away from the border, and businesses liable for the VAT now have to register and account for it on their UK VAT return. So from the end of the transition period, for goods located outside the UK at the point of sale and sold to customers in the UK and Great Britain, those customers will have UK VAT charged at the point of sale. And for goods located outside the UK and EU at the point of sale and sold to customers in Northern Ireland, those customers will have import VAT charged. And it's the location of the goods at the point of sale that matters rather than the location of the seller in each case. We have also made online marketplaces responsible for collecting VAT in certain circumstances. So where an online marketplace is involved in facilitating the sale, it will be responsible for charging, collecting, and accounting for the VAT instead of the seller. For goods sold by direct sellers, so without any marketplace involvement, the seller will be required to register and account for the VAT. In terms of the £135 limit, the limit applies to the total value of the entire consignment, not the separate value of individual items within a consignment. And the last point is that low value consignment relief, also known as LVCR, which was an import VAT relief for consignments valued at £15 or less, has been removed. So what this means is VAT will now be due on all goods supplied from overseas, regardless of value. Could we have the next slide, please? Thank you. So for business to consumer supplies, or B2C, this is where the customer is not registered for VAT in the UK, or it also covers where a VAT registered customer does not provide its VAT registration number to the seller or online marketplace. So here, the seller or the online marketplace where it facilitates the supply will be liable to register and account for UK VAT on their VAT return. And if they are already registered for VAT in the UK, they will not need to register again. And for business to business supplies, or B2B, this is where a UK VAT registered customer provides its VAT registration number to the seller or the online marketplace. So here, the VAT registered business customer is responsible for accounting for any VAT due on their VAT return. And for goods imported into Great Britain, this is done by a reverse charge. And for goods imported into Northern Ireland, this can be done using postponed VAT accounting. And in both cases for B2B, businesses will be able to recover the VAT as input tax subject to the normal recovery rules. The last point covers exceptions to the normal rules. So the rules do not apply to consignments containing excise goods or to non-commercial transactions between private individuals, for example, gifts. So these goods will be subject to the rules for consignments of goods valued above £135, with import VAT typically being collected at the border. Okay, that's it for this section. I'll now hand over to my colleague Phil for the next part. If we could have the next slide, please. Thank you.
Thanks, Will. Good afternoon, everyone. My name is Phil Crawley, and I work within the Northern Ireland VAT Policy and Delivery team at Hmrc. In this section, I will be explaining how VAT interacts with the Northern Ireland Protocol. So if we can pull up the first slide, please. To begin with, I'll touch upon how VAT will work for movements between Great Britain and Northern Ireland, as I'm sure some attendees will have a presence in the UK. So for most transactions, goods being sold between Great Britain and Northern Ireland, the VAT registered sellers should continue to charge their customers VAT and account for it on their VAT return. A key something to note is that it will now be import VAT, which means that VAT is calculated on the customs value of the good, which includes any incidental expenses and any customs or excise duties that are due. Import VAT will not be paid at the point of arrival into Great Britain or Northern Ireland, as it will be accounted for via the seller's VAT return. The customer will be able to reclaim import VAT subject to normal rules. However, there is a new requirement where a business moves its own goods from Great Britain to Northern Ireland. Again, import VAT will be due, and the business may reclaim that VAT as input tax subject to the normal rules again, which means that there should be no tax effect for taxable businesses, as they will claim input VAT on the same VAT return they account for the output VAT. An import VAT charge does not arise where a business moves its own goods from Northern Ireland to Great Britain, unless it is done as part of a sale or supply of the goods. So can we have the next slide, please? Here are some exceptions to the previous slide. So goods subject to the domestic reverse charge rules, goods declared into a special customs procedure, in which case the customer or importer accounts for the VAT when the goods exit the procedure. Goods subject to onward supply procedure, in which case the VAT is accounted for in the EU member state of destination as acquisition VAT and is relieved at the border. And as Will has touched upon, goods sold by a non-UK seller through an online marketplace, in which case the marketplace is liable to account for the VAT. So next slide, please. Quickly touching on VAT groups. VAT groups can continue to include members established in Northern Ireland as well as those established in Great Britain. There are a couple of exceptions to the way that intra-group transactions had worked previously. Supplies between group members where the goods move from GB to Northern Ireland. should be accounted for as a movement of own goods, as detailed in the previous slide, and supplies of goods in Northern Ireland in situations where at least one of the member is not established in Northern Ireland, then VAT will apply, which should be accounted for by the VAT Group's representative member. Next slide, please. Goods moved or sent between from Great Britain to Northern Ireland by unregistered businesses or individuals will also incur import VAT, though in most cases the liability is going to be reduced to zero. That's because there's a legal credit applied, which effectively is up to the amount of VAT that had previously been paid on the goods in Great Britain. In situations where this credit can't apply, where goods were not previously subject to VAT, or where the value of the goods has significantly increased, import VAT will be due. Individuals and non-VAT registered businesses carrying the goods will need to use the relevant app to pay the import VAT, and the same group sending goods will need to use a different solution, which is going to be rolled out later this year by Hmrc. Next slide, please. Goods moved or sent from Northern Ireland to Great Britain will not incur import VAT unless subject to a VAT res claim. VAT res technically is still available for Northern Ireland retailers to visitors from Great Britain, although the retailer will have to collect the import VAT due on behalf of the customer and account for it on their VAT return. This effectively means that the VAT refund granted by the VAT res scheme and the import VAT that the NI retailer will have to charge should really be the same amount and net off to zero. For that reason, retailers may decide not to offer VAT res to visitors from Great Britain. Next slide, please. So moving on to goods moving between Northern Ireland and EU member states. In line with the protocol, supplies of goods from Northern Ireland to the EU and vice versa continue to follow intra-EU rules. So this will remain pretty much as it was prior to the end of the transition period. When we talk about supplies from NI to the EU and vice versa, we focus on where the goods started and ended, not the place of the business's establishment. So a business established in London that sends a good from Belfast to Madrid will be making an intra-EU supply. The supply of services is not covered by the NI protocol. However, the rules for the place of supply of services are broadly unchanged. Some exceptions are covered here in the slide, and there's guidance available on gov.uk going into further detail on the provision of these services. Next slide, please. For business to consumer sales, distance selling rules continue to apply. So sales from an EU member state to Northern Ireland. If an EU business makes more than £70,000 worth of sales to NI consumers annually, they will have exceeded the Northern Ireland distance selling threshold, meaning that they must register and account for the UK VAT on their NI distance sales. For sales from Northern Ireland to EU member states, each EU member state will have its own annual distance selling threshold. So NI businesses will have to take account of this. So, for example, if they exceed the Spanish distance selling threshold, they would need to register for Spanish VAT. So businesses in Northern Ireland should be aware that they are aware of each member state's threshold where they make sales to consumers there. For business-to-business sales, the customer should account for acquisition VAT. The recipient must account for any output tax on their VAT return and may also treat this as input tax on the same return subject to normal rules. Northern Ireland sellers sending goods to a VAT registered customer in the EU, the Northern Ireland seller will have to zero rate the goods. Northern Ireland sellers will continue to submit EC sales lists, although these will only include goods as supplies of services are not covered by the Northern Ireland Protocol. Next slide, please. There is a new requirement for businesses carrying out transactions with the EU to use the XI prefix. This applies to VAT registered businesses who receive goods in Northern Ireland from VAT registered EU businesses, who sell or move goods from Northern Ireland to an EU member state, or that sell goods that are located in Northern Ireland at the time of sale. HMRC have identified these businesses that require the XI prefix, although businesses who haven't yet been identified can notify HMRC to request the prefix through submitting a G form. Businesses that have an XI prefix continue to appear on VAS on the web, so that EU businesses can continue to check their VAT status and verify that they are trading under the NI protocol. Next slide, please. The EU VAT refund system is available to businesses with an establishment in Northern Ireland or who make supplies in or from Northern Ireland or EU intra-community acquisitions. Businesses who meet those conditions will be able to use the EU VAT refund system for VAT incurred in an EU member state for transactions for which the invoice covers goods only. The same will apply vice versa for EU businesses in EU member states who incur VAT in Northern Ireland. The EU VAT refund system will be applicable to them only in respect of goods. If the businesses don't meet those conditions, or if the VAT invoice contains a transaction in services, the EU 13th directive process must be used. Under this, a claim is made to the national tax authorities in the EU member state in which the VAT was incurred. Next slide, please. So in this section, I'll talk through some complex journeys. Please note what is described here only applies where goods move between Great Britain and the EU via Northern Ireland. For direct movements between EU and Great Britain, the processes that my colleagues described in the earlier part of the presentation apply. So firstly, where goods are sold from Great Britain to the EU and they move via Northern Ireland, the VAT treatment will be dependent on where the goods are, where the transferred the rights of the goods or the point of sale is made. If the goods are located in Great Britain at this point, the seller charges the customer VAT and accounts for it on its VAT return. The EU customer will be able to recover the VAT either using the EU VAT refund system, or if they're registered for VAT in the UK, they could use their UK VAT return. As previously touched on, if a non-supply procedure is used, VAT is due in the EU member state of destination. And additionally, if a customer special procedure is used, such as transit, import VAT is due where the goods exit the procedure. The importer will have to tell the seller when they use one of these procedures and provide the required references so that the seller in Great Britain can zero rate the export. So next slide, please. Here's a visual example. So to begin with, the goods are kept at premises in GB and sold to the Spanish customer while they are there. Therefore, UK VAT should be charged to the customer. Samir charges import VAT, which should be accounted for via his UK VAT return. The goods then make the crossing to Northern Ireland. No additional import VAT is payable as part of this process. And after that, the good can move freely from Northern Ireland to Spain, either directly or via another EU member state. Once the goods arrive at the customer's address in Madrid, the customer can recover the VAT paid using the EU VAT refund system or the UK VAT return if they have one. Next slide, please. If the goods are moved to Northern Ireland before being supplied, then two separate movements need to be accounted for. The first is a movement of own goods from Great Britain to Northern Ireland by the seller. This is then followed by an intra-EU sale. So next slide, please. Again, the goods begin in Charlie's depot in Great Britain. They're then moved from there to be stored in a depot in Belfast. Charlie must account for this as a movement of own goods to Northern Ireland, accounting for import VAT, and can reclaim this subject to normal rules. The goods are then moved to the depot, and once they're there, they are then supplied to a customer in Madrid. Now, this is accounted for as an intra-EU sale. The goods are freely transported to Spain, and they arrive at the customer's address in Madrid. The VAT is reclaimed via the customer's VAT return if they're VAT registered. Next slide, please. So the reverse journey, where goods are sold from an EU member state to Great Britain and go via Northern Ireland, the EU business will have to charge the customer UK VAT and will have to register and account for the VAT on a VAT return. The UK customer is able to reclaim the VAT as input tax subject to normal rules. Next slide, please. So as you can see here, the goods begin at Spanish premises. They are then sold to a customer in Great Britain while they are there. And as the goods are moving via Northern Ireland to the final customer in Great Britain, UK import VAT will need to be charged at the point of sale and accounted for via the seller's UK VAT return. Therefore, he needs to be VAT registered in the UK. The goods are then freely transported to Northern Ireland and then make a crossing to Great Britain. When they arrive in Great Britain, no additional import VAT is payable as a part of the customs process, as the import VAT is accounted for via Abdul's UK VAT return. The goods then, once they arrive in at the customer's address in Great Britain, they're able to recover this as import VAT via their UK VAT return, subject to normal rules. So next slide, please. So here are some of the key guidance pages that describe what has been discussed today by myself and my colleagues. So here we have guidance on postponed VAT accounting and imports, including how to account for import VAT under PVA and get your monthly PVA statement, as well as pages on how imports into the UK should be treated. Next slide, please. Again, just further guidance here on how to submit your VAT return and imports and acquisitions from abroad. Next slide, please. And here are the pages covering VAT under the Northern Ireland Protocol, including pages on movements between Great Britain and Northern Ireland, imports into Northern Ireland, and requirements related to the XI indicator for moving goods between Northern Ireland and EU member states. Next slide, please. So that concludes our part of the presentation. I'll now hand over to Hannah to take us to the next bit of the webinar. Thank you.
Great, thank you so much. What an informative presentation. Thank you so much, everyone. Well, yeah, so we now, as you can see on your screen, we now have a poll. So what I'm going to do is I'm going to activate the poll now. And if you wouldn't mind, all of you who've participated, if you wouldn't mind participating in the poll, sharing your answers with us, it would be very much appreciated. You can just see there's just several questions there, and we'll keep that open for a few minutes, and then we can move into the Q&A. So you should be able to just view the poll on your screens now. Thank you so much for those of you who are filling it in. We'll just leave it open for another 30 seconds, a minute or so we can collect some your feedback, which is really useful, and we'll move on. Right, brilliant, thank you. Well, what I think we'll do is I'll just keep the poll on in any case, but what we will do now also is move on into the Q&A part of the session too. So if any of you have any questions for any of the speakers, please send them across to us now, which you can do so either using the chat function, which you'll see on your screen there. There's also the Q&A function as well, and we'll hand those over to the speakers. Okay, so just one question that we've got then to begin things is someone's asked about VAT changes with regards to supplies of B2C digital services, for example, apps or computer software. What are the changes that you could highlight with regards to this?
Hi. Unfortunately, the policy colleagues that handle supplies of services are not here. What I can do is take that question away and come back in writing if that would be helpful, and also provide links to the appropriate HMRC guidance on that.
Yeah, brilliant. No problem. Thank you. That'll be great. Another question we've had is for recovery of VAT on imported goods, what is HMRC's definition of used for the purpose of the business? Does this mean the importer has to own or have title to the goods at the time of import?
So David Pruden here. Again, possibly best to give the people who have responsibility for that aren't on the call. There is some specific guidance about that issue. It does not change from the 1st of January. It's exactly the same issue that previously existed with regard to what precisely constitutes ownership of goods and change of title. There has been some new published guidance about that, I think earlier this year, and there was a revenue and customs brief issued about that in October last year. So I think, again, probably easiest if we give you the appropriate links to that guidance.
Great, thank you. Someone is that'll be great. Someone has also asked if you can address the supply of services from the UK to Spanish institutions, or generally the key VAT changes for service providers.
Thanks. Once again, all sort of everything related to the supply of services, we're probably better off picking up offline. So we'll involve the sort of appropriate colleagues that we have and provide links to the guidance as appropriate. But yeah, best for us to take that one away.
Cool. No problem. Thank you. Another person has asked if we do not register the invoices with postponed VAT, how can we claim the VAT?
So, I mean, there's no requirement for invoices in respect of postponed VAT accounting. So the import VAT that is due is that which is calculated as per the customs declaration. So it should be the import VAT that then appears on the Pva statement. If when you're issuing invoices that is showing different amounts, then obviously any differences between what's been included on an invoice and what's included in the Pva statement needs to be reconciled to identify why there is a difference. I mean, it could, for instance, mean there could be some additional charges which weren't reflected in the customs declaration, which have subsequently become due. But essentially, we're under customs rules now, and it's customs rules which determine the valuation of the goods and therefore the amount of VAT that's due.
Brilliant, thank you very much. Another question we've had is in regard to the postponed VAT accounting statements, does the total VAT amount have to match the figure in the books? I'm working on a Q1 2021 VAT returns at the moment. And none of and it doesn't match the statements and manual adjustments needed.
I'm trying just to. So are we talking about the amount that goes into box 7? Again, it should be the value which is derived from what goes onto the Pva statement so it's the customs valuation which really determines the value for imports. And that, I should say that isn't any different from what would have previously been in place for the rest of the world to UK imports before the 1st of January. So PVA makes no difference to that. The value for imports is what it would always have been. I can maybe take that question away to see if there's anything further I can advise on that. But I think essentially, probably those who are used to the acquisitions VAT system are used to the EU to GB system, which is all based on invoices. And that isn't the system we're in anymore, but presumably people are continuing to, to make use of the existing functionality to make sure that that invoices values are marrying up. But it's the same point to my last one. Essentially, it's the valuation as per the customs declaration and customs rules which decide what figure should be entered onto the VAT return for value of imports.
Brilliant, thanks, David. Yeah, the person who asked that question actually just qualified what she said. I was talking about the postponed import VAT. Accounting softwares have been updated to account for postponed import VAT. Just to clarify there. So
the software. Yeah, it probably depends which software that you're using. You can make. We recognise because some of the requirements for PVA only came through quite late in the day, that not all custom software developers were able to update their software in time for the introduction of PVA, and it's entirely acceptable in those circumstances to include adjustments outside the normal making tax digital system for calculating values to be used if the software isn't yet able to deal with that for you. So hopefully that answers the question.
Perfect. Yeah, thank you very much. Another question we've had is we are a moving company, it's like a relocation company, and we have used household goods. Do we not need postponed VAT, or can we also do this?
I'm not sure I quite understand that question. My inclination is that if you're talking about moving or importing goods, then you're going to be looking first at the customs rules for how that is done and how that is valued, and the VAT largely, and the calculation and liability to import that largely follows the rules that apply for customs. So I think that, as far as I understood that question, I think it may be a customs question, and the answer to that will then determine how the VAT rules work.
Great. Okay. Thank you.
Yeah, I mean, just look at it. Just so I've seen that come up now.
Yeah.
Yeah. If it is an import, and it's for use in the business, then PVA should be available. But I still don't entirely follow the question there. So there's a question there about return goods relief as well. Is that connected?
Yes. Oh no, that's a separate one. Sorry, I was about to move on to that one now. Yeah, would you like me to? Shall I read it out?
Yeah.
Perfect. So someone has asked to claim relief for return goods. Do the goods need to go back to the same supplier and the same country that they originally came from?
Again, that is a customs question. So it doesn't. So if you return goods relief, will apply. The rules apply customs rules, and so there's nothing really to say about it from a sort of import VAT PVA perspective, I don't think, because that is simply determined by customs rules. But I think we can take that away and point you into the right direction.
Okay, brilliant. Thank you. Well, yeah, thank you for everyone who wrote those questions. And yes, just to what I just want to say is, I'll just see if this is another one. Oh, yeah, that was just the last one. Thank you so much for answering those questions. Anyone else who has any questions, if they're maybe quite specific or something, please do send those to me. Everyone who's joined the session should already have my email address. If not, you will have, because I'm going to circulate it after this session. And so if you have any other questions related to VAT and its impact on your business, please send those to me, and I will communicate those with the speakers today, and we can do our best to help you. But thank you so much, David, Will and Phil. We really appreciate you sharing all of this insight with us today, and the presentation was so useful. I'm sure it's helped many of the people who've joined. And yeah, I'd like to say that I will also after this in a follow-up email, I will share the presentation that the speakers have used today as well. So you can refer back to that if you need to at any point in the future. But yeah, thank you once again for your time today, guys. It's really, really useful. Great, and I think we'll just leave it there then. As a reminder, please do get in touch with me if you have any follow-up questions now. Thanks. Bye bye.